Are you the CFO of a U.S. company looking to expand into Canada? Well, you're going to need a tax plan and a tax framework to do so. But not to worry, because that's what today's video is about. Hey, how are you? I'm Duncan McPherson, and welcome back to my channel. If you're the CFO of a US company, there's a couple of things I want you to do. The first one is listen on. And number two is I want you to visit my website, MacTax.com, and click on the CFO Toolkit. There, you'll find things to help you navigate the tax jungle. And you'll also find tools there to help you navigate the US tax jungle. And you'll also find some financial tools to help you run your business. Have a look at it. Give me a call. I hope you find it useful. Okay, now back to today's video. So you're expanding into Canada. Well, you know what? You're going to need a tax plan, but that's okay because that's what today's video is all about. And as always, hit on that subscribe button and hit that notification bell or contact me directly through the MacTax.com for more personalized assistance. That's what I'm here for. Okay, so you're moving into Canada. Well, the first decision you're going to have to make is this. Are you going to enter Canada as a branch of your US company, or are you going to incorporate up here? Well, quite honestly, unless you have a de minimis level of activity, you're going to incorporate. Let's just leave it at that. And the second decision you have to make is what kind of corporation? Well, you really have only two options in Canada, a C Corp or a ULC. Now, these two types of entities are taxed exactly the same in Canada. The only difference between them from your perspective is that down the road, if you wanted your Canadian corporation to be a disregarded entity, you want to have a ULC. The ULCs qualify for check-the-box treatment and you can make them a disregarded entity. A Canadian C Corp is a per se corporation as far as the IRS is concerned, and it does not qualify for check-the-box treatment. So if you think you're going to want to be a disregarded entity, incorporate a Nova Scotia and Alberta ULC. Otherwise, it doesn't make a difference. If you're still a little confused about this, don't worry about it. Just contact me through the MacTax.com. That's what I'm here for. Now, the next thing we want to do is take a look at tax minimization. Now, we have a really good tax treaty between Canada and the United States. But you know what? No matter how good the tax credit mechanisms are between our two countries, there is always inefficiencies. So you want to repatriate as much of your Canadian profits as possible without them being subject to Canadian tax or Canadian withholding tax. Okay, here we go. There's a few things you can do here. And the number one, and it is the obvious one, equitize your Canadian company with an intercompany loan from the US parent. The interest on this loan goes from Canada to the US free of withholding tax. Only two things you got to look out for are our thin cap limits, which are the exact same as yours. And number two, the interest has to be at a fair value rate. But this is the easiest and most efficient way to repatriate profits. Don't forget you have to have a bona fide loan agreement between the two countries. Without a legal obligation for the Canadian company to pay, Canada may say, with no legal obligation, there is no interest expense. Make sure you have that loan in place, complete with interest, repayment terms, and whatever else goes into a third-party loan. Now for the next one, and this is a big one. Before you get going up here, identify all the services your U.S. parent company could possibly be providing to the Canadian subsidiary now or in the future. Make a list of these things and think it through carefully. And when you can bill for these services, they go from Canada to the U.S. without any withholding tax, and they're deductible in Canada. Yes, the billings are taxable in the States, but there's no tax inefficiency. And if your corporation happens to be in a state with low or no state tax, then when you can do this, it's a really good tax arbitrage. Now take note, these charges will be subject to the transfer pricing rules between our two countries. Assume for this, the Canadian and US transfer pricing rules are the same. For something like this, the subtle differences don't make much difference. But whatever you need in the US for transfer pricing documentation for an intercompany charge, you're going to need in Canada. And remember, you can also charge for things such as intellectual property and technical know-how. But when it comes to these two things, the transfer pricing documentation standard is a little higher. It is in the US too. If you need some help, just give me a shout. Okay, now I'm going to digress for a second. Heads up here and listen carefully. Do not do what I'm about to tell you, ever. There are a lot of companies that take a look at their head office charges. They pick it up, have a look at it, and say, you know what? Canada should be paying 8% of that. And they take a look at all those fees, take 8% and bill Canada. The problem is this. In Canada, and the same problem exists in the United States, any unsubstantiated management fees are subject to 25% withholding tax. If you want to bill your services between Canada and the United States, you just can't, 8%'s good, and bill it you're going to get yourself into trouble. Whatever you're billing for has to be itemized, it has to be invoiced, and it has to be invoiced at fair value. Remember that. You can get yourself in a lot of trouble with blanket management fees. I know it slides under the radar, but the way the computers work up here, if they decide to go after that, they can do it like that. I know in the United States it's a little more relaxed when it comes to management fees. Don't count on that up here in Canada. And to delve into a little deeper with this, when you are charging fees between Canada and the US, they have to be at fair value. Should CRA come in and determine that they're not at fair value, say you overcharge by 20 grand for a certain fee, they can recharacterize that $20,000 as something different, like a dividend or a management fee, and make it subject to withholding tax. So be sure whenever you're charging these fees, they are substantiated. If you have good documentation to back up your fee and CRA still disagrees with you, we know from experience that if you have good documentation, they will allow you just to reverse, in the example I gave, the $20,000 and won't turn it into something like a dividend or a management fee. But you show up with no documentation, you're going to get yourself into trouble. You're going to make that 20 grand something else other than a deductible expense in Canada. You're going to be subject to withholding tax. You're not going to get a deduction. And in the United States, it'll be taxable. So make sure you got that back up. Something I forgot to mention, for these services, just like a loan agreement, you have to have a contract in place that requires Canada to pay these fees. Without the contract, without a legal obligation to pay, the CRA is empowered to take the position with no legal obligation to pay. There is no expense. They don't normally get that strict, but why take the chance? It doesn't take much to do up the contract. Make sure the contract spells out the services, spells out the prices for the services, and spells out the payment terms. That will always keep you out of trouble. And finally, invoice for these services. That gives you your complete circle of documentation. You're going to make CRA happy. When they see the circle of documentation, they tend to not look at it as hard in the first place. Never forget that. Complete circle of documentation is everything. You'll find stuff in my CFO toolkit about the circle of documentation. Go have a look. It's very helpful. Here's something you always have to look out for when you come to Canada, and that is depreciation vis-a-vis the GILTI tax. Canada, like the United States, has bonus depreciation. The problem is our bonus depreciation is a lot higher than the ADS rates that you must use to calculate your ENP. I have seen situations where the adjustment for ADS greatly increases ENP over what the Canadian taxable income was, so much so that your tax rate drops below the high tax kickout rate for the purposes of the GILTI calculation. And in fact, I have seen the ADS adjustment on the ENP raise the ENP to the point that the taxes paid in Canada on that ENP drop below 13.125%. That is the rate that you must be paying to avoid the GILTI tax. So watch out for the ADS adjustments. It can end up causing you tax, but there is an easy way out of it. And here it is. In Canada, if you're allowed to deduct up to $100,000 for that asset, you can deduct anything between 0 and 100,000 under the Canadian tax code. What we do up here to make things congruent for the GILTI tax is we deduct depreciation at the same rate as the ADS. There's other strategies you can do. That's the basic strategy to avoid paying the GILTI tax. But make sure you look at this from the beginning, because what happens if you don't look at this problem from year one? A few years down the road, you can get a huge basis difference in your assets for Canadian depreciation versus ADS. And once this happens, you can end up getting such an incongruity, you can end up paying a lot of GILTI tax. So make sure you look at this from the beginning. Just because you're not paying any GILTI tax in years 1, 2, or 3 doesn't mean you're not going to have a problem in years 4, 5, or 6. Be sure to always look at this. If you've been up here for a few years and you haven't taken a look at your GILTI ADS Canadian depreciation problem, don't worry. We do have things we can do. Just contact me through my website. We'll go through it together. We'll work out a plan. You'll be fine. And you know what, guys? That's it for today. But before I go, I'd like to remind you again to go to my website, themactax.com, and have a look at the CFO toolkit. You'll find it very helpful. The information from this video, i.e. a tax framework for expanding into Canada, will be posted there shortly. So go have a look. It'll be there if you need it. So if any of this hit home, you can rewatch the video or give me a call through my website, themactax.com, and let's get chatting. So in the meantime, stay sharp, stay compliant, and stay out of tax trouble. And I'll see you on the next video. Take care.